What is mortgage insurance? This is Ryan Wheeler with United Residential Mortgage, and in this video, I'm going to share with you what you should know about mortgage insurance. So if you're putting down less than 20% to buy your house, you're probably going to be required to get mortgage insurance on your loan. So mortgage insurance is basically protects the lender if you default on the loan. So, mortgage insurance is not required on loans like VA, home loans for veterans, but if you're getting a conventional loan or FHA loan or a USDA loan, it's important to understand the different insurance options that you have. So mortgage insurance offers greater access to home ownership for borrowers who are unable to pay the 20% down payment. And the reason is years and years ago, you had to put 20% down when you got a loan with the bank. So it was required 20% down on a loan or you can't get a house, period. There were no other option. The reason for that is if the bank has to foreclose on your house and they have to sell it at an auction, normally they're only going to get max 80% of the home's value. Therefore, they would lose that other 20% of the home's value if they lent any more above that. Well, somebody came up with the idea decades ago, said, hey, why don't we put an insurance premium in place to cover that difference, that shortage, to allow other people, since it's so hard to get the money, the 20% down, buy a house. Why don't we create this mortgage plan or mortgage insurance that protects the lenders? So basically, it's an insurance policy that you're paying for monthly to protect the lender against your default. If you default, that lender will file an insurance claim just like you would if you got in a car accident, and basically that insurance claim would help them make up the losses in the event of a default. So private mortgage insurance, otherwise known as PMI. So it's a type of mortgage insurance that you're going to normally be required to pay on a conventional loan if you have less than 20% down. Conventional loans are just standard loans by Fannie Mae and Freddie Mac. They typically require higher credit scores and offer competitive interest rates, but FHA loans, for example, putting less than 20% down, they're also going to have mortgage insurance, but you're going to have mortgage insurance on FHA regardless of your down payment. They call it something a little bit different, MIP, mortgage insurance premium, but we're going to cover these two programs and a few others in this video. So there are several different kinds of home loans for borrowers with low down payments, and it does make sense. There are also some conventional options called lender-paid mortgage insurance premiums where you get a little bit of a higher interest rate in which you qualify for, but you have no PMI. Those don't always make the most sense, but we evaluate the options when we're working up your pre-approval or when you have a contract and ready to move forward on a house. So if you get a conventional loan, your mortgage lender is probably going to arrange for the PMI or the mortgage insurance with a private company. That's why it's called private mortgage insurance. So it's another company in the process. So the underwriter kind of sets that up and establishes that, and they write an insurance policy on the loan. So it varies by your down payment, your credit score, whether it's a primary residence, things like that. So these things make sense, but it can generally be a little less expensive than FHA, but FHA just recently reduced their mortgage insurance premium. So it has been reduced substantially, that monthly mortgage insurance premium. It's called MIP again, and then for conventional, it's PMI. So same thing. It depends. But if you have a lower credit score and you look at a conventional loan, your PMI is going to be way higher on conventional than what it would be FHA. Plus your interest rate is going to be lower on FHA. So FHA is generally going to be a little bit of a better option in those scenarios anyway. So most private mortgage insurance is paid monthly. With little or no initial payment up front required at closing, but there are some that you can do single premium mortgage insurance or lender paid mortgage insurance. These things that I'm talking about, these are big chunks. Don't normally recommend it. Most of the times these things don't really make sense, but those options are out there and available. So, and then, once you're paying your loan down, you get to, under certain circumstances, you can cancel the PMI. Generally, when you hit that 80% mark, you can have it requested to be canceled. And if it's before on your amortization schedule, the payment that takes your balance below that 80% mark, if you get there but first because you think your values went up and you've paid extra on your loan, you can call the company. They may have to do an evaluation or send out an appraiser, and you can have your PMI drop, at that point. FHA is a little bit different, but on how that works, and it can be for the life of the loan unless you put a certain down payment, like 10% down. But here's what you should know about PMI. So the most common way to pay PMI is a monthly premium. The premium is added to your mortgage payment. So it's part of this PITI, principal, interest, taxes, and insurance that you may hear some of this jargon, but PITI plus MI. So you may also have the option of paying for the PMI in that one-time upfront premium that I mentioned. So it's called single premium PMI. It's paid at closing instead of monthly. Sometimes you have the option to pay both upfront and monthly premium. So you could partly upfront premium and partly monthly premium. So, but how much does PMI typically cost? It can cost anywhere between 0.25% and 1% of the entire loan amount divided by 12. So it's times that loan amount on an annual basis, and then they divide that by 12. So, if you had a $100,000 loan, you'd be paying as much as $1,000 a year, and then it comes out to $83 a month. That's probably in a worst case scenario. PMI for conventional is much cheaper now. It has been reduced drastically, and the better your credit score, which you wouldn't normally be doing a conventional loan unless you had a good credit score anyways, it's going to be substantially cheaper. It also is dependent upon your down payment. So if you're putting a 15% down payment, you're almost at that 20%. The PMI and a high credit score, the PMI is very minimal. I think you'll be shocked at how low it is. I know over the years in the past, people have heard these horror stories and people think about PMI and it's like something that keeps people up at night, but it's not nearly as bad as what you would think. But with FHA mortgage insurance, again, it's the Federal Housing Administration, otherwise known as FHA, and their mortgage insurance premium is called MIP. And so this kind of goes into a pool. It's a government agency. This money goes into a pool, and it basically funds the program, and it works the same way. It goes into a pool just like an insurance pool does with any private insurance. That money's paid in monthly, and if somebody defaults, a lender can then file a claim with FHA to help make up some of those losses that they in the default or the foreclosure process, which they normally will. They got to sell it at auction and take a lot less. And so if you're doing an FHA loan and you only do 3.5% down payment, and then the lender has to sell the house at auction because they foreclose, they can lose a lot of money. Obviously, that's a big percentage, 16, 17% that they're going to lose on their money that they lent out. So they can file a claim, help make up those losses. Same with the conventional loan. Some conventional loans for first-time home buyers, under certain income limits, you can do as little as 3% down. So again, that's 17%. If the house sells at 80% at auction, sometimes they don't even get that. If it sells at 80% at auction, that's 17% that the lender loses. So in that case, they file a claim with this insurance premium. They would be paid out of that pool. The money's pooled. This is how all insurance works. Everybody pays in. It goes into a pool. When somebody files a claim, they pull the money out of that pool and pay the insured person for that. Same concept with this mortgage insurance. So I know a lot of people look at it like it's the devil, the PMI, but think about it. If everybody had to have a 20% down payment, we would have a lot less homes and a lot less homeowners out there. It would be a lot harder to attain home ownership, and the pace at which you're gaining equity definitely outruns the cost of PMI. So you're gaining a lot more equity. You're gaining more equity faster than the PMI that you're paying. So the net profit is substantially better. So FHA does include both upfront and monthly costs. So upfront cost is paid as part of your closing costs. It's just built into the loan. You don't bring it to closing or anything. They take your base loan amount, which is after your 3.5% down payment, and then they add that. It's like 1.75% of the loan. They add that to the loan. And then you also have a monthly cost. It's been reduced to 0.55%. So 0.55 times the loan amount divided by 12 comes out to your monthly amount. So that's basically how it goes. So everybody normally rolls that into their loan. You could, pay the upfront fee out of pocket, but nobody does that. Absolutely nobody. So to get, FHA's maximum financing, in most cases you're going to want a 620 credit score. Most lenders can go down to a 580, but I'm telling you, just trust me when I tell you this, that 580 and below that technically can go down below that. But that 580 to that 619 score, your interest rate is going to be so much higher. You're going to pay so much more in closing costs. You're going to have to pay points. Your rate's going to be 1% higher than if you just got it above that 620 mark. So it makes all the financial sense in the world to get you over that hump. So even if it takes a couple extra months just to get you there, I highly recommend doing that and waiting for that. What you should know about FHA mortgage insurance, there's two kinds with the FHA, the upfront mortgage insurance premium, which is the UFMIP, and then the mortgage insurance premium. So that's just the MIP. That's the monthly, basically. So you're going to be required to get both types when you get an FHA loan. So How much does it cost? The upfront, again, like I told you, is 1.75%. They just add that to your loan amount, and then the annual cost is 0.55%. It just went down recently, so that can vary a little bit. That can actually go down a little bit depending on whether you do a 30-year or 15-year, and whether you do a larger down payment or not as well. So a VA home loan, backed by the Department of VA, there is no it has no monthly mortgage insurance. So the VA loan is obviously just for veterans and their families if the veteran passed due to service-connected disability. So there's no monthly mortgage insurance. However, you do pay an upfront what they call a funding fee, which is essentially the same thing. It's a mortgage insurance premium. It's just paid up front, not monthly, and it's just pooled into the loan. It funds the program as well. And the amount of that fee is just based on your down payment. Essentially, you can do zero money down with VA, but if you put 5%, it'll go down. If you put 10%, it'll reduce that amount as well. Also, if you're a disabled vet, 10% or more disabled, you are entirely exempt from that fee too. So that's another thing to keep in mind as well. But that is it's called a funding fee, but it is essentially a mortgage insurance premium. So like with other FHA loans, you can roll the upfront fee into your mortgage instead of paying it out of pocket, but doing so increases the loan amount and overall cost. So you should plan on paying the mortgage insurance if you're putting less than 20% down on a home. So in many instances, mortgage insurance can be canceled after you pay that 20% of your home's value with a conventional loan, or if you have an FHA loan. Once you get to that point, we're probably going to refinance you into a conventional loan at that point. That would be the easiest, quickest way to get you out of that. We could do a no to low cost refi to get you out of the PMI. So just check with your mortgage lender for these options. Mortgage insurance allows you to get in a home with less than 20% down, which normally financially on paper, and I'll do another video on this in the future, makes sense. It makes sense to buy a home now, pay the mortgage insurance, than to wait until you have 20% saved. I can promise you that the appreciation of the home in that time, if it takes 5 years to accumulate that 20% down, that appreciation that you're going to get 5 to 8, let's just say 5% year over year, is going to outpace saving up in the savings that you would get for the PMI. I'll do another video on that next time. So even though it's an added expense, it allows you to get into your home sooner with that 20% down. Thanks again for watching, guys. This is Ryan Wheeler with United Residential Mortgage. You can connect with me. You can shoot me an email at the information below, ryan@unitedres.org, or jump to our website, unitedresidential.net, unitedresidential.net. Schedule a consultation with me at schedulewithryan.com, or just reach out. Give me a call, shoot me a text, 270-228-0075, 270-228-0075. Thanks a lot. Take care. Have a wonderful day. We'll see you next time.